Welcome back. So over the course of August, we saw a number of questions, from you that clustered around the idea of market resilience. Looking at, is this rally real? Is the air quotes the bottom going to drop out on us? Is it sustainable? I detected a lot of anxiety about where the market is here at the moment. So I wanted to take a few minutes and discuss this. So I'm going to look at things two ways: qualitatively and quantitatively. The first thing, qualitatively, we have to go back and think about market behavior, right? And there's an old saying that I did bring back, and I am bringing back into conversations here, and some of you will remember that, and it's the analogy of the pain or the embarrassment machine. And really what that is there's an old market Wall Street wisdom that basically says that the stock market will do whatever's necessary to create the most amount of pain or embarrassment to the greatest number of people. And given the level of anxiety about the market, the skepticism, and frankly the positioning, which is positioned for a decline, it would be very, very embarrassing and painful for the market to continue to climb. So if we think of this as a machine that wants to produce the most embarrassment, or pain, then the most normal thing would be for the market to climb higher. Now, that's a quantitative sort of behavioral way of looking at things, not very scientific, but it does explain the way the market has seemed to act in the past. Now, if we look at this a little bit more quantitatively, and we do look at history, we do see that there's been many of these type of what we like to call waterfall declines. So we saw a very, very sharp decline of approximately 7 weeks into April 8th, and then we saw about 11 weeks to recover into into late June. Now, the fact that there was no recession helps lead to that type of a bounce. And the second thing is that the bounce that we saw coming to April was very, very normal after one of those waterfall declines. Usually there's a ratio of 1 week down, 1.4 weeks up into recovery. And that we saw that play out almost perfectly with 7 weeks of decline into April 8th and approximately 11 weeks of rally into the week ending June 26th. So that played out very, very normally. Driving that, obviously, is the fact that, again, there was no recession. If you don't have a recession, these market drops tend to recover very, very quickly. The second thing driving this is just that earnings have been very, very strong. U.S. earnings growth was very, very strong and far exceeded expectations. So we know that if corporates are resilient and there's no recession, the market should, in fact, be higher, and that would be normal. If the market was lower, in fact, that would be abnormal. And what I do want to point out that so far, what we have seen is that a lot of the statistics I shared with you in April and May that pointed to brighter days ahead are broadly working out. They're roughly giving us a type of return magnitude in roughly the same, a time frame that is historically normal. So although it does feel very unsettled out there right now, in fact, everything that's happened is historically normal. And we should take comfort from that, the fact that we are literally experiencing a time where it feels unusual, but we are not in a situation where there's anything new under the sun.